Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
And I'm Tyler Warner, small business owner with a lot of accounting questions. And today we're talking about let me just make sure I get this right, 4 costly miscategorizations, right?
I thought it was 5.
5.
Maybe even 6. Might even bonus.
That was the first costly miscategorization.
Right.
So 5, this is when ultimately you're like reconciling a transaction and you put it in the wrong category.
Yeah, you're doing your own accounting and you put it somewhere it shouldn't be, or you don't classify things properly in the accounting software.
Right, and what happens is you turn that over to your CPA if they're doing the end of year tax return.
They chastise you.
Yeah, if they're good, they'll at least if they don't care,
that's right.
They'll just take it as it is, and
right.
It could end up costing you more in your tax return.
Yeah,
right?
So kind of a couple things on that. Like you and I were talking before we got on here, and one of the things, which is why having just a tax-only engagement is not the best for you a lot of times, is because, and I've seen this a million times with other CPAs, if they're only paid to do the compliance aspect of your engagement, like end of year, you send them your QuickBooks. We don't say it often around here. It's kind of like a bad word.
Sure.
But you send them your QuickBooks file. You have not paid them, or they don't assume you're paying them to go line by line through your transactions and make sure. Now, they'll do high level. They'll move a few things around. But some of the stuff we're kind of talking about here, especially if you're going the cheap route, they're literally filling out the forms. I hate to say that. That's what they feel the engagement is. And so if you mess these things up, nobody's catching you, which is why I always recommend, if you have any sort of business that's worth something, have somebody look over your shoulder or have somebody do it for you.
Yeah.
Yeah.
All right. Let's dive in.
Let's get into it. All right. This one's interesting because from an accountant's perspective, I always think like, why would you do this? But like, I get it. Like people think in terms of income or inflow and outflow, right? Mm-hmm. Which is why most people run their business based on their cash, what's in my checking account.
Right.
It's up, it's good, it's down, it's bad. Okay. So I think this is where this comes from. Loan payments or loan proceeds, they count as income. So I've seen this before where somebody borrows money, they pull money on their line of credit. That's a perfect example. They got in a pinch, I pull 50 grand on my line of credit, and they show that as income. So let's stop there. When you borrow money, it's not income. Similarly, when you pay it back, it's not an expense. Only the interest portion, right? So think of it this way. If I borrow $50,000 and pay $52,000, what did it cost me? It cost me the $2,000 of interest. That's the only thing that would be deductible. So I've seen this a bunch.
But is a line of credit different?
A line of credit is borrowing. Whether it's a loan, a line of credit, it should
I must have made this mistake.
It should be on your balance sheet.
Okay.
So
that might be what it is, because I'm like, this mistake feels familiar.
This one cuts close.
Okay. That might be what it is. I might have had it on my right. If I would have marked it as income, it would have been on my P&L, but not in my balance sheet.
That's right. And I will tell you why I started off with the inflow and outflow concept.
Because you're getting personal. It's getting personal now.
Yeah, well, I wasn't going to go there. But people think it was inflow, i.e. income, and when I paid it back, outflow, i.e. expense. Okay. So my net inflow or outflow is what I made this year, right?
Right.
But I hope you know, if you borrowed $50,000 and didn't do anything else that year, you haven't made or lost anything.
Right.
You didn't make $50,000 and you didn't lose $50,000. You don't have anything. Mm-hmm. You have cash of $50,000 and you owe the bank $50,000. Yeah. That's the balancing transaction. And so I see that a lot. Not say caveat. Something I would say to that is that's the reason why we do the accounting the way we do. You ever work with an accountant and they're like, hey, I need to know what your loans are, what the balances are to the year. That's why. Mm-hmm. Because when you reconcile somebody's accounting and make sure the balance sheet ties down, we've talked about a lot, if the balance sheet's correct and the P&L has to be correct in a net perspective. You might have something in office expense, but it should be janitorial,
right,
but it's still an expense. But if the balance sheet is right, your P&L is right. So if you're not an accountant and you're doing your books, this is why you put things there, because you don't know to go to your balance sheet and be like, wait, we owe $50,000. Why didn't our balance sheet show that? You don't know to look for that.
Yeah.
That's the first one I see a lot.
All
right. Keep going?
Yeah.
Number 2. I'm looking at my thing, loan proceeds. No. Fixed asset sales.
Okay.
All right, so let's talk about fixed assets. Fixed assets being things you have bought, typically that have more value. Think equipment, computers, vehicles.
These are also things that you probably would have depreciated.
That's right.
Okay.
So you would have capitalized them and depreciated them. Whether you
capitalize them, what does that mean?
That means put them on your balance sheet as an asset, not expense them
right.
as like you would do with paper clips.
Sure.
Okay. And so if you sell, let's make some sense of it. Let's just say you properly put a vehicle on your balance sheet for $30,000. You didn't expense it, and then you sold it for 30. No, you wouldn't sell it for more. You sold it for 22. Mm-hmm. Well, if you just put all 22,000 as income on your P&L, but don't recognize that you hadn't then written off the corresponding asset, you've way overstated your income. Mm-hmm. I see that all the time, where people and I will say this: anybody that's kind of a DIY bookkeeper, that's a hard one. Because you wouldn't know, you may not have your depreciation schedule. You don't know how to pull an asset off and move it to offset that gain, but that's a big one. Like if you don't have,
and usually it's like years later too. So like, I
you
can
may
see
or may
how
not
you're
have some remaining basis.
Yeah, we got that 15 grand for the truck. Let's just mark
income.
it as special income, whatever in your P&L.
Dude, you're on fire today.
Yeah, I've made so many mistakes that
you're like Thomas Edison. He said, I didn't mess up 1,000 times. I figured out 1,000 ways it wouldn't work.
Yeah, basically.
Yeah, that's fine.
Yeah.
All right. So that is fixed asset sales.
Okay, and so those, like you said, those are
just
larger
nuanced.
items.
Yeah, it's just nuanced. It's like, hey, man, we didn't take accelerated depreciation on that vehicle for whatever reason. You still have some basis left.
So this is kind of in the weeds here, but like specifically, and I would imagine it would work on most, but for zero, if you were to do that, you could literally just put that as a negative to that same account. Or how do you do that?
That's a really good question. That's a better way to do it than putting it straight on your P&L. Well, I would probably do it this way. Again, and this all presupposes you have somebody working with you, looking at it, checking you at the end of the year. I would probably put it, you said a special income account, what I would call other income, or stuff below the line, meaning you have income and operating expenses that gives you a net operating income, and then you have other stuff below the line is what they kind of call it. Depreciation, interest income, kind of things that are off, not in normal operations. I'd have it right there smack dab in an account called sales proceeds from fixed assets. That way any accountant, they're going to go right to that and be like, hey, would you sell? And they can click in the detail in the memo line, you'll say 15,000 for old truck or something.
Yeah, but there's a way in zero to get that, right? To update your balance sheet.
Yeah, well, I wouldn't put it on the balance sheet initially. I would put it there. But yes, eventually whoever's doing your books would then go pull that fixed asset off the balance sheet and put it as a reduction of that sales proceeds or the reduction of that gain.
Okay.
That's what would happen.
All right.
Does that make sense?
I think so. I think I'm following.
I'm looking at your face. I'm not so sure.
It's hard to do with zero in front of you.
Right.
You know what I mean?
Right.
But ultimately, the point is there's a way.
Yeah, I think the takeaway would be if it's something like that, put it in an account called sales proceeds of fixed assets or something like that below the line, other income type thing that where it sticks out and somebody finds it and they make the necessary adjustments.
Okay.
All right. Let's go to the next one. Personal contributions to the business. We're on the income side. So we'll do 3 kind of inflows and 2 outflows. Personal contributions to the business coded as income. Again, just like when you take money out of your business, like a distribution, there's caveats to it, but generally it's not taxable. When you put money into your business, it certainly shouldn't be income. I'll give you a perfect example of this. Somebody had a PPP loan, a client of ours. They didn't tell us about it. And they were taking that PPP loan, and this is like loan proceeds, but it's same thing for capital contributions. And they were putting it into they were transferring the money. They'd gotten a PPP loan. This happens a lot, or happened. PPP is kind of a one-time deal. They had it at another bank. So it was a bank account we weren't monitoring, and they didn't tell us about. They were transferring from the other bank to their operating account and saying it's income. It was like 50 grand. We kind of, I forget how we figured out that that's what that was. And we said, wait, is this what this is? And then we were able to say, no, that's just a reduction of the other account and an increase to this one. It's a non-taxable thing.
Yeah.
But I see people do that all the time. Like they'll transfer money from their personal, because generally they'll have the business and personal account to the same bank. And so it's like, oh man, we're kind of getting low in the account. I'll transfer 10 grand over.
Or from business to business. I've done that.
Yeah.
You know?
Income. Boom. It's like, whoa, it's not income, man.
Yeah.
Like, and that's an easy one. And the way I kind of spot that normally is those around numbers. You don't you don't normally transfer to from your personal account, 7340.
Right.
You'll transfer $7,500, 10 grand, 2 grand, whatever.
Right.
So that's a big one too. The thought process should be anything around contributing money and distributing money generally isn't income nor is it an expense.
Mm-hmm. I think the idea of just like income, and did you do something for this? Did
That's
you
a good
earn
point.
it? You know?
Did you
Isn't it
render
called earned income?
Yeah. Well, yes. Yeah. You would say, did you render a service? Did you sell a product?
Yeah.
Did you get a commission? Like, think of all the things that are income.
Right.
You putting money into your business is not income.
Yeah.
That's capital. That's equity.
Yeah. Okay.
Make sense?
Yeah. What is there like a? Does that money not get taxed the same way? Like what's
It's not tax. It's not income.
So it's just.
It would go on your balance sheet as a contribution. It would be an equity. So
okay.
you're already kind of sitting. I've said this a few times now.
Yeah.
This concept of things that are on your balance sheet aren't taxable or deductible, at least not currently, right? And if
Okay, but wait.
Oh, light bulb here.
This might have been what I was getting confused. Okay. You pay taxes. Do you pay taxes on loans and lines of credit?
No.
What the heck?
And thank God you don't.
Yeah. What am I getting confused? There was something.
Oh.
I'm telling you, man. You made me pay taxes on something.
I didn't make you pay taxes
no,
on
you
anything.
did. It was you.
Listen, I'm trying to get the following up. We want 1,000. We need 1,000 listeners, not 50.
Yeah, all right.
All right.
Fair enough. It was my mistake.
Yeah, it was your mistake. I appreciate that. All right. So we talked about loan proceeds, personal contributions to the business. And you could think about it. Those are more like funding your business. If you think about funding my business, generally not income.
Right.
You made a good point. Did I do something to earn money? That's kind of what should kind of click in your mind. Like, oh yeah, okay, I get it.
Yeah,
That's
yeah.
income.
Yeah.
And then what do we say? Oh, and fixed assets.
Yeah, the government only wants the money you sweat for, you know? They just
Right.
Yeah.
Whatever you say, Tyler.
All
All right. So we'll kind of dovetail into this. I love people. Somebody said that they're like, you say dovetail a lot. I'm like, I didn't even know I said that. But anyway, here it is.
Sure.
So let's get on the outflow side. So if you put money into your business, it's not taxable. When you take money out, so let's talk about that. Not in the form of a salary. So like if you would get a W-2 wage, you'd pay yourself a net payroll. That's deductible, right? If you pay yourself a salary, the company deducts it and you pick it up as income, you as the owner. So it's a wash, but it still is deductible by the company. But if you just take money out, not in the form of payroll, but in the form of a distribution, dividend, owner's draw, I'm kind of thinking of all the terms people use, personal distribution, all those kind of terms synonymous, that's not deductible. I get why people put it on their P&L. I think in one of the first episodes, you were like, it's a crime that it's not deductible. What was that what you said? You said something like, oh, it's a crime.
Yeah.
But anyway, it's not deductible.
Okay.
But when you put money in, it's not taxable. They go hand in hand. I see that. I've seen that a lot. And people also kind of inadvertently do that by spending business money on personal things and coding it to an account that it would go to if it were business. So I bought my son a computer. Well, that should go in office expense. Well, yeah, if your son works for the business, or you get my point. Yeah. That's not deductible. So that's the one I see a lot is just people putting personal distributions on their P&L.
Yeah, and that just is kind of annoying, frankly, if you're living out of your business.
Correct. Yeah, we can do a whole episode on segregating your business from not commingling and all that kind of stuff.
Yeah. Okay.
All right. Last one. Payroll tax deposits.
Wait, I don't know if I understood that. Okay. So how were you? You're just saying don't categorize stuff.
Yeah, I'm saying, well, if something's personal, it's personal. It's an owner's distribution. It shouldn't be an office expense.
Gotcha. Okay, I see that.
Makes sense. But generally,
so if you buy your kid a computer, don't put it as office expenses. Correct. Put it as owner's draw.
Right.
Yeah.
That's right.
Yeah, that feels familiar. I pretty much went through my transactions one time in Zero. It was like anytime there was an ATM, I was like, that's probably an owner's draw.
Yeah, probably. Right. But if you do it on the front end, you wouldn't have to think about it later.
Right.
Yeah. Anyway, that's a different podcast. All right, so payroll taxes. So I would say this. If you put payroll taxes are normally deductible. What's not deductible is the part that relates to employees withholding. And so as I'm saying this, even if you did this, your P&L wouldn't be in the net in the wrong. It wouldn't be wrong in the net sense. But what would happen is you would be understating your salaries and overstating your payroll tax. The two of which, I know you're shaking your head.
Yeah.
I know. Hold on a second. I'm going to get to a point.
Okay.
What I mean is when you understate your salaries, there are lots of things in the tax world tied to salaries. The QBI deduction being one. We talked about that in the episode on S Corps.
Yeah.
And so this may not make your P&L wrong in the net sense, but it makes other calculations that are derived from your salaries and wages incorrect. And so that's why I want to mention it too, because there are things like the QBI, there are things like retirement planning, like they're all based on what were the amount of wages you paid. Well, if you only put on your P&L the net salaries you paid to people as wages, and then the payments you made for the taxes, which include the withholdings, your payroll tax is high and the salaries are low, the two of them together are probably still right. But the point is the salaries are low and there are other things that are leveraged off of salary deductions. So that's
trickle down economics.
If you say so.
Just meaning it. Yeah, that's not what that means.
Other things.
I was kidding.
Yeah, right.
But the point you're making is that if you're calculating like other things in the tax code off of that number, it'll be wrong.
Like a retirement plan contribution. Yeah. You would be selling yourself short because your salaries would be low. Your QBI can be tied to the amount of salaries you would pay. Well, I know here we get your W-2s, a copy of them, and your W-3. We would adjust this.
Okay.
But again, if somebody's not looking, I'm saying all this from the perspective of these are not things we do here. But I've seen these in the past, and I've seen people where like they don't think that accounting is necessary. Like I'm a bookkeeper at the office or admin can do it. They don't even realize these things, and then they don't have an engagement with somebody to catch these things.
Right.
There are all these simple things that can be caught, fixed and remedied, and then taught to the person who is handling that task if you're working with somebody.
Yeah.
And typically those people who are not interested in those things also want the greatest tax scheme.
Yeah.
It's like, look, man, you don't even really reconcile your accounts yet, so let's not talk about offshore holding companies. Right. I don't think you're there yet.
Yeah, that's fair enough. I mean, I think ultimately it goes back to the very foundational stage of recording and recording it right. And I know, like when you have that ongoing relationship and the real-time collaboration, I mean, I've gotten real-time coaching of like, hey man, I saw you posted it like this way. Right. You should put it in this category because of X, Y, and Z. And I'm like, oh, okay, all right, well, easy enough to fix once you know. Right.
No, man, the collaboration, you're talking about that first level of the total control accounting system where it's a record phase. Like if you just get that down, where you record, where you're consistent, you've got your books cleaned up, you're consistent, and you're collaborative, just that can save you tons of money and get you in a way better spot. We don't want to leave you there. We want to get you to the next step, which is now you're reading reports and making decisions and informing your staff about KPIs to look at and giving the decision makers in your business the right metrics to look at. If you just handle that first stage, you can do so much. Right. And we see that all the time. Like there's a client that I have right now that's really growing. Like their business is taking off. They have amazing real-time data. I already have a task in my project management system to talk to them on December 15th about some salary planning. We brought this QBI deduction concept. I'm not going to get into that, but there's some ways to manipulate your salary. And what I mean is just pay yourself a bonus where you're like, man, that's going to cost me payroll tax. But it makes this other deduction, this QBI, go up way more than the tax it cost you. Yeah. But because their data's so good, I'm really confident to go on December 15th and say, pay yourself a $300,000 bonus. That $300,000 bonus cost you $10,000 of payroll tax. It saved you $100,000 in income tax. The data's so good. We're going to get in there and make a decision late in the year, fully informed. I've already got it in my project management. It's going to send me a reminder email, and we're going to take care of it. But if you're not doing the foundation, you don't get to that part. Or whoever does that part with you, they're shooting from the hip because you don't have good data.
Yeah.
Yeah.
All comes back to record.
All roads lead back.
The foundation.
All roads.
That's true.
For sure.
Well, on that note, those were great. 5 inflow, outflow things to consider when you're. What do you call that? I keep saying reconciling your transactions. Is that the right term for it?
When you're doing your bookkeeping.
When you're doing your bookkeeping.
Yeah.
Okay.
Yeah, and just we hadn't talked about this, but like, just what we do here is we have 2 ways we work with clients. We've kind of developed these over the years. We have what's called DIY assisted, and we have full service. Mm-hmm. And if you come on board with us, we'll put you in one of those plans, give you a fixed rate quote. But the DIY assisted, we found for a lot of people is like kind of that sweet spot. Like the full service where you're totally hands off, we'll do it, and we have lots of clients who do it for. But the people who are in their books, it's just something that happens when they're in it with somebody right there, kind of coaching them.
Yeah,
man, it's just like a really great relationship.
I think that, and that's not to take away anything from you guys, but I think that only works because of cloud accounting.
No question. No question, because we pop in and then could look at things, send you Loom videos on how to fix it.
And it's easy to do.
Oh my God. Like if I'm in Xero, I mean, we've got, I forget how many clients in Xero, over 100. Literally, it's a couple clicks. Like it's a drop down. What client do you want to look at? Click. Like if you're in a QuickBooks desktop file, anybody who's done this, moving in between QuickBooks desktop files, it takes time.
Yeah, I want to do like the infomercial right now, like the black and white, and just like,
the Mac and PC stuff. That's funny. But anyway, where I was going with that was, if you're listening to this and you're thinking like, okay, I've listened to these guys, I like what they're saying, like that's one of the paths we put you on. That DIY assisted is great because it's monthly or quarterly. You do what you do in your accounting. We assist you. We just come behind with a set engagement to look over things, check over your shoulder, give you tips and tricks. And a lot of times those tips and tricks are in the form of like really easy to watch videos. We leave them for you to watch whenever you want, and we help you, and you get better and better and better. And what happens is your data gets better and better and better. We start making better and better decisions because we're now in it with you.
Yeah. Well, check more out at mire.group. You can find more resources, more episodes like this, and reach out to the Mire Group and see if there's a plan that fits for you. And, if nothing else, at least schedule some time with Marcus and ask all the accounting questions you want.
That's right.
All right. Have a good one.
See you next time.